Hello everyone. In this video today, we're going to be going over the concept of cash basis accounting versus accrual basis accounting. So first, we're just going to go ahead and go through some definitions. First thing we're going to do. So first of all, what is cash basis accounting? What is accrual basis accounting? Well, cash basis accounting is a method of accounting that records transactions only when cash is received or paid by a company. Okay, so when cash is received or paid by a company, the company can go ahead and record the transaction at that time. Okay, so just as a quick example, let's say we have this company and they sell t-shirts for cash. Well, then they go ahead and record revenue once they've received the cash. And the reason for that is because they've received the cash at that point, right? So they can go ahead and record the transaction. Okay, now this basis of accounting, it's unfamiliar to us. It almost seems wrong because we've always been taught to use a different basis of accounting, which is called the accrual basis of accounting. Okay, so what is the accrual basis? Well, it's a method of accounting that records transactions in the period when the economic activity took place. Okay, and so when we're talking about revenues, we're talking about when the performance obligation is satisfied. And again, we'll talk about what exactly a performance obligation is in future topics, but just for now, just definitionally, when the performance obligation is satisfied, we record revenue. And then when we incur an expense, we record it in that period, okay, when we actually incur the expense. Okay, and so let's just take an example. Let's say we have the same company as above, and they sell t-shirts for cash, or maybe they sell it on account. They go ahead and record revenue. Even if they have not received cash, if they sell it on account here, and they don't receive the cash yet, it doesn't make a difference. We still go ahead and record the revenue in the period when the sale is made, because that is when our performance obligation is satisfied. Basically meaning our performance obligation in this sense is we're supposed to give the customer a t-shirt, okay? And so we give this customer the t-shirt, we record the revenue, okay? Now this is the basis of accounting that we are used to seeing. We've used it throughout 2021, and we're going to use that in FAR 1 and also FAR 2, okay? So basically what happens is that in this topic, our main goal is to convert a company's books from cash basis to accrual basis, all right? And so the cash basis numbers are usually given information. In the problems, you're going to see that the cash basis numbers are basically just given to us, and then we're going to be asked to convert these numbers into accrual-based numbers. So we take the cash basis numbers that were given, and we go and we move them to accrual-based numbers. And how do we do this? Well, to convert from cash basis numbers to accrual-based numbers, we will be using the following ending and beginning balances for these accounts here, okay? And the accounts are accounts receivable, unearned revenue, accrued liabilities, and then prepaid expense, okay? So what we do is that we start with our cash-based numbers, we add and subtract these numbers, and then we're gonna end up with our accrual-based numbers, okay? And like it says here at the end, we add or subtract these beginning and ending balances from the cash basis numbers that are given to get the accrual-based numbers, okay? So then flipping over to the next page, basically, we have this chart here that is going to detail all the accounts, both beginning and ending balances, that we're going to use to convert from cash basis to accrual basis, and then also whether we add or subtract the account balances from the cash basis numbers that are given in the problem, okay? And so we see here, literally, it's just, okay, if it's, and what we're going to do is this chart is here, and you can look at it now, and that's great to just get an idea of what's going on. But basically for this chart, we're going to go through the intuition of it in a problem. And so we're not going to spend a ton of time here because this is just something that you can refer back to, and it's just to get your feet wet. But we're going to go through all the intuition in a more extensive problem in just a minute here. Okay, so basically beginning accounts receivable, you subtract it. Ending accounts receivable, add. Beginning unearned revenue is an add. Ending unearned revenue, subtract. Beginning prepaid expense, you add it. Ending prepaid expense, you subtract it. Beginning accrued liabilities, subtract, and then ending accrued liabilities, add. And again, when you're adding or subtracting, these are saying adding or subtracting from the cash basis numbers that we are given, okay, from the cash basis numbers that we're given, okay. Additionally, we have this template of what a reconciliation schedule looks like when converting from cash basis numbers to accrual-based numbers, okay. So we have this idea of a reconciliation schedule. We're going to see this a lot in FAR 1 and FAR 2, and so I just wanted to go ahead and familiarize you all with the terminology just because we're going to see it a lot. We might as well just get familiar with it now and just try to figure out, okay, what does this really mean? Basically, it means that you have a start point, okay? You add or you subtract some numbers, and then you have an end point. Okay, so that's all reconciliation schedule means. It means you're starting somewhere, you want to end up somewhere, and in between you had some add and subtract numbers. Okay, you're doing some mathematical computations. All right, and so when we're talking about converting from cash basis to accrual basis, we have these different schedules here that I've sort of laid out. And again, this is sort of a template that you can use when you're solving these problems. Okay, so to solve for accrual-based revenue on that side, we'll take cash collected from customers, which is given in the problem. Okay, this information is just generally given straight up. We take that number, and then we subtract our beginning accounts receivable, we add our ending accounts receivable, we add our beginning unearned revenue, and we subtract our ending unearned revenue, and we get to the end number of accrual-based revenue, and that's our end point. Okay, so we have a start point, we have an end point, and then these four in the middle, they're add or subtract things, right? We're adding or subtracting something. So we can see this is a reconciliation schedule, and this is for the revenues. And then we have the same thing, a very similar thing on the accrual-based expense side. Okay, so what's happening is we're starting off with cash paid for operating expenses, which is given. So again, this is our starting point. These four numbers in the middle are adds and subtracts, and then we end at the point of accrual-based expense. All right, and again, these add and subtracts are the same as they are up here in the chart. This is just to get your feet wet and just to see, okay, this is the general idea of what we're going to be doing. And then all the intuition of all this stuff is going to be walked through, okay? But our goal basically in this is to convert from cash basis, okay, to accrual basis. Cash basis to accrual basis, okay? So hopefully that's clear for now, and then we're just going to move to the next page. We're going to go over this page quickly, and then we're just going to have a quick problem. Okay. Well, it's going to be a little longer, but you know, it's just one problem, relatively lengthy, but yeah. So basically, how are we going to solve these problems? Well, there's a 4-step process that I've created that you can kind of use to solve these problems. Okay. So, and again, these will make more sense when we go through the problem, but let's just go through it quickly so we can get an idea of what's going on. First, the first step is that we want to think about what the account balance represents conceptually. Okay, we see here it's a C chart below. That means this chart at the bottom here. And so, just as a quick example, this chart, what happens is that it says the account and its beginning and ending both, and then it says what does it represent on a conceptual basis. So this is basically for step 1, right? Okay, and so we're talking about it just as an example. Well, what does that mean? What does it mean to say what does it represent conceptually? Well, for beginning accounts receivable, what it represents conceptually is revenue that was earned in the last period that will be collected in cash during the current period. Okay, and so we want to be aware of that for each and every one of these accounts, beginning and ending balance, because that's going to help us determine whether we add or subtract the number from the cash basis numbers given. Okay, so second, we determine whether the account balance is already included in the cash basis numbers. Okay, which are given, the cash basis numbers are given, right? So we determine whether these account balances are included in these cash basis numbers. Third, we determine whether we want the account balance to be included in the accrual basis numbers, which we are solving for. Okay, and then the fourth step is once we perform these first 3 steps, we can determine whether to add the balance or subtract the balance from the cash basis numbers to get to accrual basis numbers. Okay, so we think about what it's conceptually, and then we do steps 2 and 3, and then we can determine, okay, do we add, do we subtract, all right, to get to accrual-based numbers. And so this chart here, again, is just for your own reference to come back to. I'm not going to walk through each and every one of these right now because we're going to do it in the problem, and it'll be kind of redundant. But basically, if you ever are struggling as to what an account means, right, what does it represent on a conceptual level, which is very important to understand, you can always refer back to this. Okay, so let's just go ahead and go through the problem. So here we go. We have XYZ company, and they use the cash basis of accounting. Okay, the company began operations on January 1st of 2015, and it is a calendar year company. For the year ended December 31 of 2018, the company has the following data concerning its account balances. Okay, and so basically what we're given in this chart here is we have the accounts, right? Accounts receivable, unearned revenue, prepaid expense, accrued liability, and then we have the beginning balance, and then we have the ending balance. Okay, that's what's given in the chart. And then additionally, we're told during 2018, XYZ company collected $50,000 from its customers. That would be cash collections, right? And they spent $23,000 on operating expenses. That's actually cash paid out for operating expenses, okay? So basically right here are the given cash numbers. These are the given cash numbers right here, 50 and 23,000. Okay, we're going to use those to solve this problem. Okay, and so we're just going to go through, we're just going to have to determine what they want us to do and then just solve the problem. So it says required, prepare a reconciliation schedule to convert XYZ company's cash basis net income to accrual basis net income for the year ended December 31 of 2018. Okay. So the first thing that we want to do is we just want to determine what is the company's cash basis net income. Well, it would just be the $50,000 that they collected, okay, in cash, minus the $23,000 they spent on operating expenses. It'll be $27,000. Okay, so that's the first thing we want to determine, just to get an idea of what the cash basis net income. And again, this is net income in parentheses, or sorry, not in parentheses, in quotes, because it's not net income in a traditional sense, right? Net income is accrual-based expense subtracted away from the accrual-based revenue, right? But this is the equivalent of what net income would be on the cash basis side. Okay, that's kind of why I have it in quotes. Okay, so now we're going to prepare a reconciliation schedule like it said to do in the problem. So we're going to solve, the first thing we're going to do is solve for accrual-based revenues. Okay, so the first step in doing that is to say, what is the cash collected from customers? Okay, that's given to us. It's $50,000. We saw that above right here. It's $50,000, okay? Then we need to do our add and subtracts to get to our accrual-based revenue number, okay? So first, we have beginning accounts receivable, and it says we're going to subtract that, okay? This is the $10,000, okay, right there. It goes right there as a subtract. Why are we subtracting this, okay? Well, we have to think about, okay, beginning accounts receivable, okay, what does that represent? Well, beginning accounts receivable would basically be revenue that we earned in the prior period, right, but we're collecting in cash now, right? So that means it's not revenue of the current period, it was revenue of a prior period, right? But the issue is that we collected this $10,000 in cash, right? This is cash collected from customers, and we're trying to get to accrual-based revenue, right? So it's not revenue, so we want zero as the ending amount for this specific $10,000. We want zero as the accrual-based revenue number. However, when we're starting, we have $10,000 in the cash collected from customers. So what we do is that we subtract out $10,000, right? Because we need to basically cancel out this effect. We don't want to include it in the final number, but it is included in the previous, in the cash collected. It's included in the prior balance, okay, of cash collected, okay? Then we have ending accounts receivable. It says that we add that. Why does that make sense? Well, we have to add that because accounts receivable, the ending balance would represent revenue of the current period, right? It's revenue of the current period because we made the sale this period. However, it's not going to be collected in cash till the next period, right? So within this $50,000, for this one transaction, we have zero, right? But we want $7,000 as our accrual-based revenue, right? We just said it's revenue of the current period. We want it to be included in the final revenue number. However, we don't have anything included in the cash collected from customers. So that means that we have to go ahead and add $7,000. Okay. Next, we have beginning unearned revenue. It says to add that. Well, why does that make sense? Well, that makes sense because beginning unearned revenue would be revenue of the current period, right? We actually go ahead and we earn that money this period, right? However, we are going to collect the cash. We already collected the cash last period. Sorry, we already collected the cash last period, but we're going to earn the revenue in the current period, okay? So that would mean that there'd be $0 related to this beginning unearned revenue within this $50,000 because we collected the cash last period, but we want $6,000 in revenue for this period, okay? And so that would mean that to reconcile that, we have to add $6,000 to the unearned revenue, the beginning unearned revenue. We have to add the $6,000 because we want to be included in revenue this period, but there's nothing included in cash yet, okay? Finally, we have ending unearned revenue. It says to subtract that. Why does that make sense? Well, ending unearned revenue would be revenue of the next period, but it was collected in cash this period, right? So within this balance, we would have $20,000 for the ending unearned revenue. We would have collected that this period. And then the issue is that we don't want anything in the ending balance because it's revenue of the next period. So what we do is that we subtract out $20,000 to cancel that effect out. And then if you just do the math, accrual-based revenue is $33,000. Okay. Next, we have to do the accrual-based expense side. So we're basically halfway done. We just have to do the other half of it. Okay. So we start out with cash paid for operating expenses. That's given. That was $23,000. Okay, it's just up here at the top, says cash paid for operating expenses. Then we go to the add and subtract portion. Okay, so first, beginning prepaid expense. Well, it says to add that. Why does that make sense? Well, beginning prepaid expense would be an expense of the current period, but we paid out the cash last period, right? And so what happens is that within this, there's $0 of cash paid out, right? But at the end of the day, we want to have accrual-based expense, right? And we know that we're going to have $5,000 of expense there, and we have 0 to start, so we add $5,000. Okay. Next, we subtract away the ending prepaid expenses. Why does that make sense? Well, the ending prepaid expense conceptually represents that it's going to be an expense of the next period, but we paid out cash this period. Okay. And so what happens with that is that we actually end up in a situation where it's an expense next period, but the cash is paid out now, right? And so that means that we have $3,000 of cash paid out from this $23,000. Okay, it's $3,000 of cash, and it is included in this operating expense. But at the end of the day, we don't want any accrual-based expense for this number, okay? Because it's not an expense of the current period; it's going to be expense of the next period. So we subtract out the $3,000. Next, we have beginning accrued liabilities. We subtract those out. Basically, what that is beginning accrued liabilities. Forgive me if I said expense, but beginning accrued liabilities, what that represents is that it's an expense of the prior period that's going to be paid off this period, right? So we actually paid out cash of $4,000, so that this would include $4,000 of expense, but however, we want 0 in the final balance related to this beginning accrued liability because it's not an expense of this period. It was an expense of last period. So we go ahead and we subtract out the $4,000. And then finally, ending accrued liabilities, we add those. Why do we add those? Well, we add those because conceptually, ending accrued liabilities is an expense of the current period, but it's not paid out in cash until the next period, right? So within this $23,000, we would have 0, right? It's not paid out in cash yet. It's paid out next period, but it is an expense of the current period. So what we do is that we want $9,000 at the end, right? Because it is an expense of this period, and we start out with 0, so we have to add $9,000. And then if you do all the math, you end up with $30,000 of accrual-based expense. Okay, and then the last thing here, which is at the very bottom, it says, what is the accrual-based net income? Well, the accrual-based net income would just be $3,000 because it's just the accrual-based expense of 33, subtract away the accrual-based revenue of 33 minus away the $30,000 of expenses. You end up with $3,000 of accrual-based net income. So that's it for this lesson.